I personally think that we have some more pain before things get better. It seems like these days there's just this near constant discussion of whether or not we are in a recession. Are we in one currently? Were we in one and now it's over? Are we about to be in one? There is a lot of confusion about this term, and rightfully so. There is also some fear about recessions. So today, we're going to dive into it all. We'll talk about what a recession is in the first place, whether or not we're in one right now, and I'll provide an outlook for 2024. Before we get into this, guys, I want to talk to you about BAM Capital. Imagine this. One day, you are a struggling investor managing the day-to-day hassles of property management. And then next moment, bam, you are earning monthly distributions without lifting a finger. And that is exactly what BAM Capital does. With over $1 billion in transactions, BAM Capital is the multifamily syndication that lets investors step away from the tenants and the toilets and into targeted returns of 15 to 20%. So if you're an accredited investor who wants cash flow stability, like we all do, and also long-term appreciation, as well as accelerated tax benefits with an experienced sponsor who has average returns over 35% IRR, head to bamcapital.com/BiggerPockets. That's bamcapital.com/BiggerPockets to invest today. When talking about a recession, let's just talk about what a recession is in the first place. A recession is one of the generally agreed upon 4 different phases of the business cycle. The business cycle is this concept that market economies, like that of the United States, go in cycles. So when times are good, things are known to be as expanding. That's when the economy is growing. At a certain point, the economy reaches a peak where the economy just can't grow anymore, or it's too hot and there's too much inflation. And then it goes through a period of contraction, which is also known as a recession. So it's a normal phenomenon within a normal capitalist market economy. Of course, we don't like them. We wish things could just go on and expand and grow forever. But unfortunately, to date at least, we have not been able to accomplish that. So recessions are somewhat inevitable. The definition of a recession, and whether we're in one or not in one, is actually somewhat of a confusing and kind of controversial topic. So let's just jump into that for a second. In the United States, an official recession is actually not defined by any objective measurement. It is actually decided by a group of economists. And contrary to popular belief, this is actually how recessions have been defined in the United States for decades. This goes back to the 1970s. At the National Bureau of Economic Research, the NBER. And these people are members of something called the Business Cycle Dating Committee. Like we just talked about, there is this business cycle, and these people are responsible for putting dates at when the expansion starts, when the peak is, when the recession starts. Basically, they're the ones who are figuring out when one part of the cycle starts and one part of the cycle ends. And I know that there is a common shorthand that's used, which is 2 consecutive quarters of negative GDP growth. And that is often used as sort of this shorthand for when we're in a recession or not, because oftentimes we are waiting for the National Bureau of Economic Research to decide there was a recession, and they won't make that decision until months or perhaps even years after the recession has started, or even after the recession has ended. That is one of the unfortunate things about the way this works in the United States, is that it's retroactive. And so we have this official designation that takes a really long time. And so a lot of times people use this 2 quarters of negative real GDP growth as their definition of a recession. But it's important to know that 2 consecutive quarters of GDP growth, while commonly accepted as a marker of a recession, is not the official definition of a recession. To understand the official definition of recession, you can actually look this up. You can go on the National Bureau of Economic Research's website, and they say that the definition emphasizes that a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. That, to me, is a very broad and confusing definition, right? It's basically saying the economy does poorly on a broad set of criteria for some amount of time that is more than a few months. So I think you can see why there is so much confusion and controversy about whether we're in a recession or not, because the committee that is responsible for it has a very vague definition. So basically, a recession is a subjective measurement. And that is actually one of the reasons I don't love using the term recession, because honestly, basically, it's just a group of people's opinion. It comes retroactively, and we want to know what's happening in the economy right now, right? So that's what we're going to do today. We're going to look at some economic indicators and decide, are we in, an economic downturn today? And is it likely to get better, get worse, or stay the same in 2024? So if you dig into the Ember website, you see that some of the main criteria that they're talking about are GDP, which is gross domestic product, basically the measurement of total economic output for the whole country. Then they also look at stuff like prices, retail prices, wholesale prices, manufacturing, that kind of stuff. And they also look at the labor market. So those are three things that they're going to be looking at. So why don't we look at the same three things? So the first thing is GDP. And actually, I'm recording this on October 26th, and we just got GDP data from Q3 of 2023, and it was way higher than pretty much everyone expected. GDP grew in the US at a 4.9% rate, which is a big jump up from the previous quarter when it was about 2%. And it's really important to note here that the numbers that I am citing is what is known as real GDP, which means that it is adjusted for inflation. In other words, the GDP of the US grew 4.9% more than the rate of inflation right now. And that is a lot. By historical context, that is a very strong economy. And so, again, we have to look at all these different factors. But if you were looking at GDP alone, like a lot of people like to do, and use that 2 consecutive quarters of negative GDP growth, we would not be in a recession by that definition, because we have very strong GDP growth right now and have for several consecutive quarters. Interestingly, if you look at this chart, there were actually 2 consecutive quarters of negative GDP growth, which was in the beginning of 2022, first quarter, second quarter of 2022. So a lot of people felt like that was a recession, and by that shorthand measurement, it would be. But the National Bureau of Economic Research has not designated officially a recession. All right, now let's look at some prices. There's so many different price metrics, so I'm just going to pull up retail sales because that's a really important indicator. And if you look at inflation-adjusted retail, if you look at wholesale data, the economy is actually doing pretty well. People are spending a good amount of money. Now, retail sales did actually dip for a while in 2023, and they're down not a huge amount, but by a fair percentage from their high in the middle of 2022. But interestingly, they seem to be rebounding. So where we are now towards the end of 2023, retail sales and a lot of sales data in general, I'm just showing this one chart because I don't want to bore you guys, are generally trending upward. So again, if you're the National Bureau of Economic Research and you see strong economic growth in terms of GDP and strong sales, you're probably thinking we're not in a recession. Now, the third thing that they're going to be thinking about is the labor market. And the labor market is a very confusing, controversial topic. And I think the reason for that is because there is no perfect measurement for the labor market. When you look at GDP, it's kind of cut and dry. You know what it is. The labor market, there's all these different ways to measure it. You can look at the unemployment rate. You can look at initial jobless claims. You can look at JOLTS. You can look at job openings. You can look at the labor participation rate. There are so many different things that you can look at. But to me, if you look at all of them and sort of try and just get a reading on the general trends, you see that the labor market is still surprisingly strong. I admit, I thought at this point in the tightening cycle that we would see much worse labor data. And there is some evidence that, most of the jobs are coming in low-paying jobs instead of high-paying jobs, but wages are going up faster than inflation for the first time in several years. If you also look at the unemployment rate, it's been ticking up a little bit, but it is still historically low. One thing a lot of people often ask me about is the labor force participation rate. And actually, if you look at it for the entire population in the United States, you'll see that it has been trending upward for years, but it is still below pre-pandemic levels. So that is an important factor in the labor market. But if you actually look at so-called prime age participation rate, these are people between 25 and 54, which is basically the lifeblood of the American economy. That's actually up above pre-pandemic levels. So it's confusing. There are sort of mixed signals here. But I think generally speaking, it would be very difficult to say that in an economy where there are 9.6 million job openings, 9.6 million openings right now, that we have a weak labor market. The labor market is still particularly strong. So when you look at these three things together, it would be difficult to say that we are in a recession right now. It is not my call, but if GDP is up, sales are up, and the labor market is still near historic lows for unemployment rates, that doesn't look like a recession to me. But of course, that can change. So the question then becomes, is the economy going to turn south in 2024? And the primary logic for a recession coming is what we all know. It is interest rates. For the last 18 months now, we have been raising interest rates at one of the fastest paces in history. And according to a lot of research, it takes somewhere between 6 and 18 months for higher interest rates to ripple through the economy. That means that we right now are only starting to feel the first interest rate hike, right? That was back in March of 2022. And there have been subsequent rate hikes through all of 2022 and into 2023 that we haven't even begun to experience. So to me, and guys, this is where we're sort of getting out of the realm of historical data, where we know what happened, into my personal opinion. I personally think that we have some more pain before things get better. That's just my opinion, but I do think these ultra high interest rates are going to impact the labor market. Unemployment is going to go up. I don't think it's going to be this horrible situation, but it's at 3.8% now. I think it will get to, the mid 4s, something like that, at least in 2024. And that really has implications for the other metrics that we're looking at. Obviously, if more people are unemployed or people are fearful about their jobs, they might not be spending as much. And so retail sales or wholesale prices, for example, could go down. And as a result, when prices go down or people are spending less money, GDP can also go down. So to me, it all really centers on the labor market. And although it has been surprisingly resilient, I do think at some point, businesses are going to make a pullback in hiring and it will ripple through the economy. Now, whether or not that gets officially labeled a recession or not, I don't know. That is not up to me. But I do think most Americans right now are feeling a lot of economic anxiety or a lot of economic pain. And I'm sorry to say this, but unfortunately, I don't think the end is anywhere in the next couple of months at least. I am hopeful that midway through 2024, second half maybe, that things will start to look up. But I do think we just have to see the impact of these interest rate hikes, and we haven't yet seen it all. And I just want to make one last point about the definition of a recession. And someone who came on my podcast On the Market mentioned this the other day, that perhaps the reason we haven't been in a recession, quote unquote, is because it's more of a rolling recession. And Liz Ann Saunders from Schwab suggested this idea to me, and it makes a lot of sense. In the definition by the National Bureau of Economic Research, they said that it is a slowdown in economic activity that is spread across many different sectors of the economy and lasts several months. And now, what has been going on, if you really dig into a lot of the individual industries, is that you'll see from really the last 2 or 3 years now, one sector will go into a recession, so we'll see housing, for example, we'll see a huge slowdown, right? At the same time, luxury travel will be exploding, right? And so, or retail sales will be exploding. And then housing will start to get better. And at that point, retail or travel or healthcare or whatever it is starts to decline. And so you see like industry by industry are sort of going through these sectional recessions, but it's never happening to enough sections at once for it to be called an official recession. I don't know if that's the reason, but it kind of made sense to me because as we see all these different things in the economy going on, a lot of negative headlines, but not a declaration of a recession, I thought that was a really interesting explanation of why the National Bureau of Economic Research may have not yet declared a recession. But that's just my take. Of course, we're getting a lot of new economic information and data every single day, and we're going to just have to see what unfolds over the next year. I, of course, will be providing regular updates here on the BiggerPockets channel. If you like this type of analysis, please make sure to subscribe to the BiggerPockets channel and turn on your notifications for new videos. For BiggerPockets, my name is Dave Meyer. I'll see you next week.